Stephen Dudash is with us in studio. He's the president at IHT Wealth Management, and Tom White is going to join us to do some trading in this segment as well. Steve, good to have you back. Let's talk retail here,
yes.
right? Because we've got this market where Macy's, Nordstrom, Kohl's, they've all just been getting obliterated.
Right.
But the question is, is it too much? Give me sort of your take on what's happening in the sector.
Okay, I've been very publicly against the retail sector for years now. I don't understand how you can jump in on there. The Macy's, the Kohl's, the JCPenney's, the Sears of the world, that no one goes to those stores anymore. They have lots of space they have to pay for. They cannot produce product. Whenever we're looking at buying a company, it's, do you believe they can sell their product more competitively, more effectively than their peers? Mm-hmm. Very difficult to make that argument for any of those companies right now. I give Kohl's a little bit of credit for at least trying to jump on the Amazon world.
Embracing,
giving it a chance, because otherwise they're dead in the water. So I can't tell you so it's too soon to say whether or not that saves them or not. But in the short term, that whole sector, I don't see how you can be a part of it.
Is it as far as going, taking bets against it, or is it just betting on the things that are working? Because we see these big red book numbers, right? Like 5%. We've been hitting that consistently. It's not bad, but it doesn't seem to be going to these plays. It's going somewhere else.
It's not going to those plays. You've got 20% less people going to those stores year over year. Mm-hmm. This year it's probably going to be a bigger number. So I know when we're talking about trades here, we can talk about ways of shorting it or taking advantage of it going down.
Yeah.
But I don't see how they can recover. Yeah. In this environment, in this world, the barrier of entry used to be you had to have this huge store and you had to put a bunch of product in there. It's very competitive to do it. Now you can jump on your phone and buy that same product at 1,000 different places for a tenth of the cost. I'm exaggerating there, but you get the point. The technology has destroyed that market. This is not a new story, and I know earnings are coming out and this and that. I don't care if JCPenney's beats or loses their estimates right now. I don't care.
It's about the trend, basically.
The entire sector trend, big box trend. You can make arguments for some specialized things, but big box trends is dead.
Tom, when we see a move in Kohl's, that's why I'm looking at this one so, particularly today, because to Steve's point, one, they've kind of, invited the devil in a little bit, but they also are getting wrapped up in this big macro trade to the downside. And, the pop overnight, thought maybe there was relief here, that things weren't as bad, and then we're like giving it up in the middle of the session.
Well, you think about it, comparable sales were down 2.9%.
Yeah, and they missed.
Good. And if you take a look at them over the last 10 years, they've bought back half of their share float. I mean, that's basically supported their stock over that time period. So if I look at it from, is Kohl's a name to get into buying the stock? It pays a dividend yield. That's fine. You can do that. It's capital intensive. But if you want to play it in the short term, what I looked at was doing an options trade in there.
Okay.
And basically, the stock
like fading the. It's not a rally anymore today. It was a rally for like a minute.
Yeah, it was over $50 a share. Now it's back down under $48 a share. But what I looked at was just a simple 2-month trade, doing a put calendar to the downside, which is on the 47.5 strike, where you buy the 47.5 puts in October, you sell the August 30 weeklies. You pay roughly about $1.50 debit on that, and you can see here from the setup, you get a nice range of about over $50 down to about $45 as your range in this play. It's about a 59-day trade, like I said. The debit, $150 is all you pay, and that's all the risk that you have on that trade.
Okay.
The idea is you take advantage of lower volatility, which after the news has come out, volatility's crushed in there.
Right.
And calendar spreads, when you buy them, it's a good entry point as far as the strategy goes. The nice thing is with calendars, you can put it at any strike you want, where you think that underlying is going to go over the next, 2 months.
Right.
And this trade just takes advantage of it, settling down between that 45 and maybe 50, 51.
Okay, so bearish, neutral. I want to talk also this morning, and that's for Kohl's. We've also got Home Depot out. Is there any hope, Stephen, in your mind for the companies that still do provide some kind of service to those either construction workers, people who are redoing their homes? I mean, Home Depot, it's up this morning. They've been in a nice trend to the upside. Does that still make sense?
Of course. I mean, they're selling a product that other people can't sell. You're not going to sell lumber online for most people.
Yeah.
Right.
You're not going to buy faucets to the same degree online. Some products people still need to go see and take advantage of. It's not like you can throw an Instagram model and destroy the L brand.
Right.
How Instagram has just killed that company.
Yep.
It's completely different. So a company like that, then you want to look at their earnings, you want to look at what their growth looks like. That's a company in the retail space that you could still make an argument for.
In your mind, has the sort of e-commerce play through social media shown that it's going to be as disruptive and profitable? I think from a audience perspective, they're taking eyeballs. I think about a company like Revolve that just went public. First earnings, they're struggling. But then on the flip side, you've got companies like Shopify. Is there a way on the long side to play that type of growth?
Do you believe they can start making money? Like when Snap came out a couple years ago, we were like, Snap's not making money. This is like buying the hot restaurant that burns out after 2 or 3 years. We were very concerned about that. We were very preaching that to people. When you're looking at these tech startups apps that are coming out, is it something like Instagram that can be sustainable, that people can continually use, and though they're poaching from their mother company, you know what I mean, a lot of their users are coming from Facebook.
Yeah.
It's a company that you can see the profitability, you can see the long term. The Snaps of the world, some of the newer ones.
High risk?
It's high risk. It's just like the tech bubble in the late 2000s, right? You had 50 companies came out, 3 of them survived. Okay, you can't buy the broad sector on there because you're going to have 47 losers in there. So you find the 3 that you believe can sustainably grow and make money. If a company can't make money, I don't care how cool it is right now, I don't care what the trend is right now, if you do not see how they can make money, you cannot be a part of that company.
Let's talk about a place where you do see a way to sort of get exposure to the U.S. demand, the U.S. stability. We talk here a lot about how the rest of the world, the data is worsening at a much quicker pace than in the U.S. What does that mean in terms of where you see opportunity right now? And we can branch out from retail here a little bit.
Okay, so, our U.S. economy is fairly strong comparative to the world right now. I know there's problems. I know there's trade wars. I think trade war right now is mostly theatrics. It's just a show. It's the 2 biggest economies playing games with each other for a little while. They'll work that out. So every time you see a trade war headline and the markets drop 3%, that's a buy signal in my mind. Take advantage of the show there. The U.S. economy is doing well. Interest rates are down and going down. We have at least one more rate.
Does that mean people will clamor for yield?
Exactly. They need yield. You've got these retirees, you've got people who are looking for yield, where to go with it. You can buy into the energy sector right now. It has not participated to the upside the same ways like technology and stuff in the last year or 2. So you're still getting good valuations in there, but you can find 4, 5, 6% yields on there, whereas you literally can't buy that in bonds right now. You cannot find a 6% yield anywhere in the bond world. So people that used to have to traditionally just like, I want part of my portfolio to be set in bonds so I have the stability, you have to branch out. And one of the easier ways to branch out right now, I'm not saying it's perfect, I'm sure we can make trades on it both ways, but there's nice yields in the energy sector and you're not buying super high valuations.
There was a Bloomberg story out over the last 24 hours, Tom, that said a wall of money is coming into the U.S. corporate bond space because they're not going to be able to get the yield in even the Treasury because now that just keeps going further, right? So when you look at the energy space, let's check out XLE. We know that it's been downtrodden, Steve's point, but in the event of comeback, what do you see?
Yeah, you got a lot of names in this. Chevron and Exxon being about 43% of that ETF, but you do have the Marathon oils. You've got the Valeros, you've got the Schlumberger's, Halliburton's in there that pay higher dividend yields. This one's ETF's relatively flat for the year. Oil, crude as itself, is up over 21%. But what I looked at for an options trade in the relatively short term, I went out to the October series in here, and what I did was just a simple call spread, where if you think over the next 2 months that you're going to see a pop, some demand for XLE, if crude oil rebounds, buying the 58 calls, selling the 62 calls. Volatility is relatively low in there, so buying verticals makes more sense than selling an out-of-the-money put spread to create that same bullish strategy. You pay roughly about $1.50 to $1.60 debit on that, and $4 wide vertical. You get a reward of about $2.40 on that if it goes up to about 62 at expiration in 2 months. So that's a way to take advantage of.
People start rushing in, trying to get the yield. All right, there we go. Guys, good stuff. Talking it, trading it. Tom White in studio with us as well. Of course, Stephen Dudash. Great to have you back, Stephen. Appreciate it.
I appreciate it too.
Steve is the president at IHT Wealth Management.